Swayam Prabha. Digital India. Educated India.
Valuation with WACC. I can do some valuations with WACC also. WACC is the appropriate discount rate for the firm or for a project that is a replica of the firm. Now, for the firm's cash flows, if I have to discount, I will use WACC. If another project I have to discount which is a replica of the firm, I will use the same WACC. Another firm I have to disclose for which this firm is the proxy, I will use the same WACC. WACC becomes my benchmark discounting rate out there for projects which have the similar risk profile or risk characteristics. I have got one more example out here, valuation with WACC. Suppose a firm has both current and target debt equity ratio of 0.6. Debt equity ratio is 0.6. Cost of debt is 5.15%, cost of equity is 10%, corporate tax is 34%. The firm is considering taking on renovation of a warehouse costing about 60 million and expected to yield after tax savings of 12 million per year for next 6 years. Now, question is, should the firm take up this renovation at the cost of 60 million given the cost of capital is so much, or should not do that? That is all what we are going to do. That is, I repeat, should the firm take up this renovation activity at the cost of 60 million with a particular cost of capital, because the 60 million I have to borrow or whatever it is, raise it in a combination with debt and equity, or should they not take it up if the return is going to be 12 million a year out there? Let us sort of solve it out here. I am going to go back to this. I am looking at example 6 out here. Debt equity ratio 0.6, that is cost of debt 5.15, cost of equity is 10, 34% out there. Now, I will sort of look at the weights of debt and equity out there and look at the cost of capital, look at WACC and then find out the returns out there. I am basically trying to do this. So, what is the weight of debt and what is the weight of equity? Debt equity ratio is 0.6, that means what? So, what is the weight of debt? Weight of debt. Let us look at what is the debt equity ratio out there. 0.6 is the debt out there. That means it is 0.6 divided by total capital is 0.6 plus 1 is the total capital, that is debt is 0.6 times the equity capital out there. Debt equity ratio means what? Debt is 0.6 times the equity capital in this particular. So, what are we looking at? Debt equity. Debt is, for example, if debt equity ratio is 1, say if debt equity ratio is 1.5, that means debt is 1.5 times the equity out there. So, what is the composition of debt in the total capital? Composition of debt in the total capital is 0.6 times the equity. So, what is the total capital? Total capital is 1 plus 0.6 is the total capital out there. Debt equity ratio 0.6, 0.6 means what? It is debt is 0.6 times the equity. That means what is the total capital? 0.6 plus 1 is the total capital and that is what is the denominator. So, what is the debt portion of it? Debt is 0.6 divided by 0.6 plus 1 is basically what is called as the, in this particular case, okay, is what is the proportion of debt out there. The proportion of debt, proportion in total in TC, total capital. Total capital is obviously 1, 1 minus this is going to be obviously equity. No sir, I want to verify. Let us see, no problem, you can verify. What is there? This equity is 1, we said, divided by, I will say 0.6 plus 1 is basically that is the total capital. So what? It is exactly the same thing. So what is the weight? Weight is exactly equal to this. This is the weight of the total capital out there. So what is the cost of capital in this case? Cost of debt, cost of capital, cost of debt. Cost of debt is 5.15% pre-tax. So what is the cost of debt? 5.15 into 1 minus the tax rate. Tax rate is 34% out there. That is after tax cost of capital. I will say in this particular case is after tax cost of capital. After tax cost of capital is what we are looking at out here. I am just going to wrap this text in this case. Equity, cost of equity, they have given us 10% straight away. I do not have to even worry about calculating it. Now what is WACC? My WACC is going to be my weight of the debt into the cost of debt. I have to use a parenthesis. Plus weight of equity into the cost of equity, and that is what is going to give me WACC. WACC is 7.52% out there. Now let us look at the cash flows and discounting and so on. Negative cash flow of 60 what we say in this particular case, negative cash flow of about 60 million is gone out there. That is, there is an investment of 60 million which is basically gone out there. Every year I am going to get 12 million for the next 6 years. Now what is the present value of this 12 million I am going to get? The present value of this 12 million that I am going to get is 1 plus 7.52% to the power of 1 out there, because I am discounting it only for 1 year out here. So I am discounting it only for 1 year in this particular case, and yes, that is what it is. I am just going to include a dollar symbol out here so that it is easier for me to pull it out there. So this $12 I am going to get, 12 million I am going to get at the end of 1 year is discounted at 7.52, that is my WACC is 11.160 out here. Let me do that for the entire 6-year period. I am just going to increase this because this is going to be the, it is going to be after 2 years, and then yes, this is going to be after 3 years. Yes, I am just going to increase the what do you call it as power out there, and this is going to be after at the end of 4 years out there. I am just increasing it out here, 4 years out here. This is going to be at the end of 5 years out here, and this is going to be at the end of what do you call it as the 6 years out there, and this is going to be at the end of 6 years. So what is my present value of my cash flows? Present value of all my cash flows out there is basically nothing but at some So what is my NPV? My NPV is going to be present value of all the cash flows minus my initial investment out there. In this particular case, present value of all the cash flows minus my initial investment, because it is already negative. So I am just using a plus sign out there. So what happens? Negative 3.7163 million out there. So what happens? It is not viable. If you are going to get only 12 million and your cost of capital is 7.52%, your investment of 60 million is not justified. Why? Because your cost of capital is 7.52%. Sir, if the cost of capital changes from 7.52, so I will make it 5.72, then is it going to be viable? Well, even then it may not be viable. If I change it to 4.72, is it viable? Yes, then it might be viable. So what happens? Cost of capital plays an important role in this particular aspect out here. I am just going to do what you call it as undo it. I am just going to undo it out there. So your cost of capital is WACC. and we have your outflows and inflows, and we basically calculate your NPV of the project out there, and that is what we have basically done out here. Let me move on further out here. Firm valuations. The firm valuation, we take all this present value of the cash flows, and we also look at the terminal value and so on out there. I am just giving you one more last, I think this is my this is basically going to be my last two parts of on valuation using WACC out. Now consider the Good Food Corporation, a public company, is a leading food retailer. It operates about 10,000 restaurants in 100 countries. Good Food serves a value-based menu, hamburgers and french fries. The company has a 4 billion in market value debt and 2 billion in market valued common stock. Tax rate is 20%. Good Food has estimated that the cost of debt is 5% and cost of equity is 10%. What is WACC? Let us look at first calculating WACC out there. There are two parts to this question. Let us look at first calculating WACC out there. I am going back to my Excel example and then example 7 out here. Let me split the screen so that it is easier for me to sort of go ahead. Let us sort of split the screen out here, and then I will say what is the debt portion part of it. The market value of the debt out here in this particular case is about 4 billion is the debt market value, equity is about 2 billion is the market value of the common stock. Then what is the weight in the what is the weight in the total capital? 4 divided by 6, and then it is 2 divided by 6. This is going to be the weight out here. And let us look at after tax cost of capital. I will add after tax out here. After tax cost of capital, exactly like the similar to the other aspects out here. I am just adding the after tax cost of capital out here. What is the cost of what does he say? Cost of debt is 5%. So what happens? 5 into 1 minus 0.2, that is 20% out here. He is talking about 20% out there. 1 minus 20%. 1 minus 20% out there is the cost. Sorry, I made a mistake. Yeah, it's 5% out there is the cost of the cost of equity into 1 minus 20% out here is the is basically the cost of what you call is the tax rate out there. And let us look at what is the it's after tax cost of capital is about 4%. Equity they say is 10% out there. Now what is WACC? WACC is WACC is nothing but going to be weight of debt into cost of debt after tax cost of debt plus weight of equity into after tax cost of equity into what do you call it as after tax cost of equity, and that's what your WACC is 6% out. So that we have calculated that. So now that we have done WACC, let us go to the next part of it where we value the firm. Good Food is seeking to grow by acquisition a potential candidate. Happy Meals is currently a private firm with no publicly tradable common stock, but has the same product mix. It operates about 4,000 restaurants mostly in North America and Europe. Happy Meals has about 1,318 million in debt outstanding with the market value as the same as the book value. It has about 12.5 million shares outstanding. Since Happy Meal is a private firm, we have no stock market price to rely upon for our valuation. Happy Meal expects its EBIT to grow at 10% from for the next 5 years from the current 150 million out. Increase in net working capital spending are both expected to be 24% of EBIT. Depreciation at 8% of EBIT. Perpetual growth rate in cash flows after 5 years is estimated at 2% out there. Now let us look at valuing this firm and arriving at it. What is EBIT? EBIT is currently 150. currently 150 and it is expected to grow at 10% per year. That means currently it is expected to grow at, currently it is year 0 it is 150 and it is expected to grow at 110%. So, 110% of it will be the EBIT next year. So, what happens? This into what is called as 110%, that is how it is basically going to grow, and I have my EBIT which is basically growing out there in this case. What are the taxes? Taxes in this particular case, less taxes, that taxes in this particular case in this company is expected to be around. So, now what are the taxes? If you look at, once you acquire the company out here, once you acquire this company, what is the tax rate? Tax rate is 20% for you. You are a tax rate of 20%. Look at the previous example, previous slide out there. So, the same tax rate basically continues for you. So, what happens? Your tax rate is about 20% of the EBIT out there, is about 20% of the EBIT out here. So, that is I have what is called as my taxes out here is this, the taxes. What is my EAT? EAT is after tax earnings out there. EAT is earnings after tax. Earnings after tax is what I basically got out here, and my earnings after tax is basically I basically got out here. I want to calculate the cash flows because I am looking at valuation, and I will add back depreciation to the cash flow because of a simple reason that depreciation is a non-cash outflow item out there. So, I will add depreciation to the cash flows out there. So, what happens? Depreciation is 8% of the EBIT out here. So, I am adding back depreciation in this particular case, and it is nothing but 8% of the EBIT, and that is what they say. Now, I reduce capex in this particular case. In this particular case, or the increase in working capital and capital spending are both expected to be 24% of EBIT. That is capex and working capital and everything. Increase in working capital are expected to be 24% of EBIT each. I think the word each is missed out. You can add that word each here. 24% each of the 24% of EBIT, 24% each for of EBIT out. So, what happens? It is basically nothing but it is EBIT here into 0.24 is going to be my capex out here. My capex out here is going to be this much. Same as of course with less my increase in working capital is also going to be so much out here 0.24. It is not going to be very different. So, what is my net cash flow I have? The net cash flow I will have is EAT plus my depreciation minus my capex minus my increase in working capital is what I will have, and this is the net cash flow that I am going to have out here. This is the net cash flow that I am basically going to have out here in this particular case. Now, I need to look at the valuation of this entity. What are the net cash flows? Net cash flows, I am basically going to take this as the net cash flows out here, and I am going to have this as my net cash flows out here. And these cash flows are going to continue for time immemorial. These cash flows are going to continue for time immemorial in this particular case. So, I am just going to use, I am not going to use this, I am just going to change it slightly, I am just going to say my terminal value. Because the cash flows are going to occur for you in perpetuity, So, perpetuity value of the cash flows, perpetuity value of the cash flows, perpetuity with growth. There is a growth of 2% out there, perpetuity with growth of 2% out there. What is the kind of growth that you are going to have? That is, this cash flow is going to grow at 2% out there. That is what they have indicated, divided by what is my cost of capital? My cost of capital is this minus my growth rate in this particular case. This is going to be what we call it as my terminal value of the enterprise. terminal value of the enterprise out there. Now let me find the present value of all this. Let me find the PV of the cash flows. This is the terminal value of the cash flow as on year 5, because I have used the last year's cash flow and time immemorial, and it is going to continue to grow at 2%. Yes. Now I am going to find the present value of all these cash flows. To find the present value of all these cash flows, what is it? This is going to be 66 divided by 1 plus, at what rate am I going to discount? I am going to discount it at the cost of capital out there to the power 1 in this particular case, and that is all what we are going to do out here. I am just going to use a dollar symbol out here so that I can just pull it out. So if this is going to be there, I am just going to use the present value of all these cash flows out here. I am just going to use the present value of all these cash flows. This is going to be discounted for 2 years, this is going to be discounted for 3 years out there, this is going to be discounted for 4 years out there, this is going to be discounted for 5 years out there, and in this particular case this terminal value is also going to be discounted for 5 years, because I have used what we call it as the 5th year cash flow to arrive at it. That is the value I have got as of 5th year out there. So what is the total value of the firm? Total value of the firm is nothing but at sum, if I have to look at sum of all these cash flows that I am going to get out here, that is all what I am going to get, is what we call it as the total value of the firm out there. Total value of the firm is 2177.02. What is the debt? Debt in the firm is 1318.8 million out there. I am knocking off. What is the value of the equity then? Value of the equity is the value of the firm minus the value of debt. The value of equity is about 858.22 million out there. So WACC is used for discounting and valuation of the firm out there, and that's how we use it. I hope it is clear. Now we move on from here. Am I right? Move on from here. We talked about debt and equity, but firms always have a particular combination of debt and equity. Why? Because as we go back to some of the examples out there, let us take a case, debt or equity out there. Let me take 2 companies A and B. Equity, debt, equity 100, equity 60, debt 40 at 10%. Simple. My profit before interest and tax for both is about, let us say, $10 each. My interest is $4. So what happens? 10 plus 6 PBT. My tax at 50% out there. So $5, $3 gone, 3 and $5 is PAT. Beautiful. What is the return for the equity holders? If you look at return for the equity holders, $5 for 100, $3 for 60, same 5% out there in this case. Same 5% is the return for equity holders. Beautiful. Next year, I want to increase the capital structure. I want to change. I need $20 more. I need $20 more. This fellow says I am going in for additional $20 in the form of equity. This fellow says I am going to go in for additional $20 in the form of debt. Then what happens? This interest and your performance improvement will have to happen because you made more investment. Somebody can say performance improvement will happen. Yes, it will happen. But it takes some time because you have bought a new machinery, it has to standardize, you have to get the market and everything. So immediately what happens? This $4 you have to pay instead of it $6. So what happens out here? It becomes about $4 and it drops to $2 and it drops to $2 out there. Whereas in the case A, for $5 is the return, you are getting an 120. What is the percentage return? 5 by 120. 5 by 120. You can look at what is the kind of return.
4.17.
It is about 4.17%. Whereas in the other case, you are getting $2 for 60. What is the kind of return? 2 by 60?
3.33%.
3.33%. So what is happening? Movement further crept into the company. The risk of the equity holder increases because their returns are expected to go down, or returns can go down if the company is not performing. Risk increases. So movement debt creeps into the capital structure. The equity return, the equity holder, the expected return of the equity holder increases because the risk of the equity holder increases. Assume in the old case itself, let us take the old case itself again. Let us take the old case itself again. Let us take the A and B. No capital structure change. Equity, debt, 100, 60, 40, and then at 10% and so on. And my profit before interest and tax is $10 and $10. Interest is blob and $4, 6 and 10. My PBT, and then my tax at 50% is $5 and $3, so $3 and $5. Beautiful. Now let us take a small twist here. Imagine it is a COVID year. You are not getting a PBT of $10 in both. You are getting a PBT of only about a $6 in both. COVID year. Then what happens? In this particular case, this is 6 and this is 3 and these fellows get 3 and the return is 3% for equity holders. In this particular case, this $4 remains as $4, this becomes 2, this becomes 1 and this becomes $1 out there. So what is the return? $1 and 60, 1 by 60. 1.67. 1.67 percentage. What happens? The debt interest remains a constant. Movement debt is there in the capital structure. The cost of equity increases because you forget about new debt, even the old debt. Movement debt is there in the capital structure. The cost of equity increases. So the cost of what you call equity increases because risk of equity holders. Risk of equity increases. So if risk of equity increases, cost of equity will increase out there. So then we'll eliminate completely debt, we'll have only equity. That also will not be a solution because debt is always cheaper. Debt is always cheaper than equity out there. Because what happens? Why is debt cheaper than equity? Very simple. Debt you have an assured return, risk is low. Equity, no assured return, risk is high, so expected return is high. Debt expected return is low, so debt is always cheaper than equity. So what is the problem then? Problem is let me write as debt, let us say cost of equity increases with debt in the firm, debt in capital structure. But debt is always cheaper than equity. So challenge now, let us look at the challenge is have correct combination of debt and equity so that the WACC, overall cost of capital, is low. You have some combination. If you have some combination, you debt and equity, your cost of capital is at the lowest point out there. So, the challenge is getting that right combination is basically the challenge out there of debt and equity out there. How to choose the debt and equity? Of course, there are various models. I am not getting into the models. There are Moody-Glaney-Miller models. There are various other theories. I am not getting into any of those. I am just giving you a brief idea. As I said, I am giving you only a conceptual understanding of accounting and finance. I am giving you only conceptual understanding. I am not getting into the details of it. There are models, Moody-Glaney-Miller. How should the firm choose debt and equity ratio? There is a model, should a financial manager set their firm's debt equity ratio nearly 100% or agency cost, bankruptcy cost, there are various other costs. I am going to touch upon all these things, that is all. I am not going to get into the details of it. Now, what is the agency cost and so on? What is the financial distress cost? There is debt, cost of debt, we will always have a distress, cost of distress. What is the cost of distress? I lend money or the company borrows money and the company is not able to repay. The company declares itself insolvent, like your Jet Airways and so on. So, what happens? There is a cost of bankruptcy. The cost of bankruptcy is already built in at the cost of debt also. So, what happens? If the debt also grows, then the cost of debt also keeps increasing. And then if debt in the capital structure increases, cost of equity also increases. So, what happens? If you have a very high debt, both cost of debt and cost of equity will be very high out there. So, because why? Lot of debt, cost of bankruptcy, because my risk is high in this case. So, what we call it as out there. Debt has tax benefits, it has obligatory payment, there is a default, financial distress, bankruptcy, transfer of ownership to stockholders, all these kind of things out there, cost of distress, all these are built into it out there. I have got a description of financial distress costs out there. I am not even getting into this, I am just going to leave the slide. I am just going to leave the slide as a resource for you to read up. I am not getting into the details of discussion of this, I am just going to leave this. Can the cost of debt be reduced? Yes, there are positive comments and etc. and so on and so forth out there. Now, can the cost of debts be reduced? Yes, the cost of debts can be reduced out there, the cost of debts can be reduced out there. Stockholders, as I said, there are positive comments, the stockholders might pay higher interest rate as insurance against their own selfish strategies. As what is selfish strategy you saw in the previous slide, and then it can be part of your loan document, etc. It can be broken, the coins can be broken and the coins can also be broken and can lead to default and everything. Well, there are issues in the process. There are, of course, that is a complete can the cost of debt be reduced, and what is it, what is the financial distress cost of financial distress, how to sort of take care of this cost of financial distress, etc. That is a separate complete subject by itself. Financial distress, how to mitigate the risk, how to take care of this, what are the costs, how does the cost get built in, etc., etc., etc. That is a separate subject by itself. That I am not going to deal with all that in this case. I have just given you a brief about it. After this, there are other aspects out there. There are also agency costs in equity. We talked about that, now we are looking at equity. What is agency cost? You can read up all this, no problem. The slide is going to be there with you. I will explain in very simple terms. There is what is called as a owner manager. Let us look. Who are the equity holders? Equity holders of a firm are the owners of the firm out there. Now, I hold equity shares of a company. Now, that means I am the owner of the company. I am owner to that extent of equity share I am holding in the company. But who is managing the company? I am not managing the company. I am not making any decisions out there. The decisions are made by the manager who is going to be sitting there and making decisions. It is believed that the manager sitting there is going to make decisions in such a way that it is going to benefit me, the shareholder out there. Now, I can monitor and everything, but it may so happen that the manager can make a decision which can favor him a little more, or it can compromise my benefit a little bit as a shareholder and can benefit him a little more. It can compromise my benefit a little bit and can benefit him a little more, can benefit, and that is what we call it as the agency problem out there. And there is a particular cost associated with it, and that cost associated with it is already built in when we look at the cost of equity. This is owner manager, there is a agency problem. Very simple. As a shareholder, I am looking at the long term performance of the enterprise, long term performance. The company should stay on in perpetuity. The manager is there, he is drawing up the salary out there, he is going to, and his salary is linked to the as an incentive portion which is linked to the performance out there. So, he might look at short term gains, short term performances by compromising on something on the long term goals. So, which should accrue more benefit to him as compared to the long term benefit that I am expecting in the process. Now, agency problem. That is where we always say the incentive scheme for the manager, the CEO and team will always be aligned to the interests of the shareholders. So, I will design the incentive scheme which is also in the long term for the managers out there, so that the interests are aligned out there. Now, that is one way of mitigating the agency cost. We are not even getting into that as of now. Sir, agency cost, is it only with owner manager? No, it can be with minority stakeholder and a majority stakeholder. The majority stakeholder is going to control the firm, the minority stakeholder is going to be waiting out, expecting the majority stakeholder to make decisions which is going to benefit all the shareholders out there. But he may make decisions which will benefit majority stakeholder. Lesser and less is the agency cost problem. That is, I am able to eliminate the agency problem or minimize the agency problem in my company, the cost of equity can come down. I am able to minimize what is called as the bankruptcy distress cost in my company out there, my cost of debt can come down out here. So, these are because that is not part of our concept. I am just giving you an overview. So, this debt and equity is a combination of debt and equity is a challenge. That is what every financial manager or finance manager or the CFO will basically work on, keeping the combination, right combination where my cost of capital, job of what you call it as a CFO and team, and that is what they do. Okay. With this we close this, then we move to the last part out here. Then with this we close it, we have moved only to the last part, one more part I have to cover, and that is what we talk about dividends, dividend policy out there.